Welcome to It's the Economy. India's macros present a very pretty picture. Most economists are now expecting the second quarter GDP numbers that will be announced next week to come in well over 7%, and indeed, some are even moving the full year GDP forecast to over 7%. Meanwhile, the CPI inflation, consumer inflation, is expected to be lowered by the Reserve Bank to 2% for the current year, after the record low of 0.25% that the CPI touched in October. The only fly in the macro ointment is the record high trade deficit that the country reported in October because of high gold prices, high gold imports, and lower exports to the US. The other fly in the ointment is the continuous outflow of dollars by foreign investors. To get a handle on all things macro, I have with me Pranjul Bhandari, the chief India economist and strategist for HSBC. She's also the ASEAN economist for HSBC. Good morning, Pranjul. Thank you very much indeed for joining me. Let me start with the GDP numbers. Our poll is only halfway through, but it is giving a very clear indication that we may get a number above 7% for the July, August, September quarter. Where do you stand?
Yes, absolutely. I think September is going to be a number which is going to be close to 7.5%. I think December too, we could be in the 7% plus range. So we're talking about pretty strong growth over, the first 3 quarters of the fiscal year. I think a lot of things have supported this, from good monsoons, low inflation, which raises purchasing power, tax cuts, front loading in fiscal expenditure, especially in capex. I think all of this has come together very nicely. But Latha, once I say this, I think it's also very important to look ahead. And my sense is that some of these things could reverse in the March quarter, which is the final quarter of FY26. And there are a few uncertainties which we can't ignore. I think one uncertainty is that all of this GST boost we are seeing, will that continue or will that fade? My sense is we are already seeing auto companies taking away some of the discounts. Some of the passenger vehicle registrations have come off. So we'll have to think about the longevity carefully of all of the GST boost. The second is the fiscal drag. The government has spent a lot upfront, but now nominal GDP growth is very low. Tax revenues are lower than budgeted. So they may not have the firepower to spend very much in the March quarter. In fact, they may have to cut back on spending, and that could be a fiscal drag. And the third is exports. We are finally seeing in the numbers that exports are slowing, especially to the US, but it's not that we are being able to increase exports in a major way to the rest of the world either. So I'm not seeing evidence of rerouting of exports. So my sense is we could see 7% plus numbers for the first 3 quarters, but suddenly in the fourth quarter, the number could dip to as low as 6%.
Oh, really? Actually, you kind of answered the question that I had, just an optimistic spin. Are we all being overcautious about our economy? Has the country's potential growth actually increased for various reasons? The demographic dividend, when China was in the same situation as we were, they were reporting 12 to 14% GDP. So probably we are in the 7 to 8% bracket, you don't think, for the coming few years?
Well, I think, the uncertainties that I spoke about are uncertainties which we should think about very carefully. Globally, growth in 2025 has been pretty strong, higher than expected across the world. But a lot of it has also been led by front loading of exports, because a lot of people fear what will happen once the tariffs kicking in a major way. And our sense is that because so many countries have already imported what they wanted for a year or so, actually exports in 2026 could be much lower. And globally, growth may be weaker in 2026 compared to where it's been in 2025. And, India will be a part of that as well. So while I'm very happy with all we have achieved, and we have achieved a lot, I do think we need to be careful about the uncertainties in the global growth environment in 2026.
No, I take a point. The world is not as clement to us as it was to the Chinese in the 90s and the 2000s. Let me come to inflation, where you will have a better picture since you also look at ASEAN. We have this 0.25% CPI number, and much of this is because the WPI numbers are way negative. We have probably the 5th consecutive month of a minus wholesale price number, deflation. Does that continue? Because, Asia is getting flooded with cheaper exports which couldn't go to the US. So do we have an Asian disinflation related low inflation in India as well for the better part of 2026?
Absolutely, Latha. I think low inflation is going to be a new trend out there. And on the back of that, I'm going to argue that the RBI can remain growth supportive for a pretty long time. When I look at very short-term data, we got this amazing 0.25% CPI number for October, and that did not even include all of the fall in the GST taxes. It only included a very part of it, about 1/3 of the impact. So I think that is also likely to come in a bigger way in the next couple of months. So inflation could remain low in the next couple of months too. And coming to 2026 and beyond, I have done a structural study in which I've looked at previous periods in which core inflation fell as dramatically as it's falling now. Every time in the past, it was led by growth falling. It was output gap widening that led to lower inflation. And therefore, it used to be very short-termist. As soon as growth would rise, inflation would go back up again. This time, when I'm looking at the drivers of disinflation, they are structural. It's China's overcapacity in manufacturing and therefore, cheaper imports. And that has been built over 4 decades. So that's not going to go away very quickly. And it's also RBI's credibility that has been built over 10 years as the inflation targeter, that they will keep inflation low, and markets have started to believe that. These are all structural drivers that are driving today's disinflation. And my sense is that's going to continue for a fairly long period of time. In terms of numbers, I would say for FY26 average, I think inflation can be below 2%, about 1.8%. And for FY27, I would say it can be a tad below 4% at about 3.8, 3.9%. So these are pretty low numbers for several quarters.
Okay. This actually makes the Reserve Bank, renege on its promise. It's a renege on its mandate. It's supposed to keep inflation above 2%. So how many cuts? And what in December?
Yeah, we do think that there is a cut in December. Although I must say, I think markets are right now 50-50 on it, because they are saying, yes, we understand inflation is very low, but growth is extremely strong. Why should the RBI cut? And my argument there is that actually the primary mandate of RBI is inflation targeting. So at this point of time, they'll be looking at inflation a little more closely than they look at growth. And even when I speak about growth, yes, it's strong today, but I think in early 2026, things look a little bit uncertain on the growth front. So on balance, my sense is that the RBI will be cutting in December. And beyond that, my sense is, look, we do have space for a rate cut, another one. But it could be in February or April. But right now, I'm going to focus on the December cut.
Okay, your terminal rate, therefore, is 5% for India, the repo rate.
Closer to that, yes.
Now, while it's very good that inflation is coming in lower than what RBI thought and growth is coming in higher than what RBI thought, what you are saying gives me the feeling that nominal GDP is going to be, sub 9%, not even sub 10% for FY27 as well.
Look, my sense is that, WPI is a funny animal. If it's going into deflation for next 2-3 months, it could be a very strong positive number just 1 year down the line. So from that perspective, GDP deflator could be a little higher in FY27, and we could just about touch double digits in nominal GDP growth, just about 10%. That's what I would
the reason why I'm asking is it's not just the government's fiscal deficit. It's also EPSs of companies that are linked to the nominal GDP. And if that continues to come between 8 and 9, we have a problem in terms of earnings. Since you are also a strategist for HSBC, this is my question to you. Do you see foreign funds, therefore, changing tack? The second quarter EPS growth has been far better. It ends a long 5-quarter drought. Do you think that, we can upgrade the earnings forecast for the next 4 quarters? And do you see any sentiment change in FPI? Does it change into inflows anytime soon?
Right. So to the extent corporate earnings link up pretty well and are very correlated with nominal GDP growth, my sense is that December will not look very good, in the sense that we think it's going to be a quarter in which the real GDP growth will be higher than the nominal GDP growth, which basically means that the deflator will be negative. So, you have to keep that at the back of our minds when we think about corporate earnings. But as soon as we hit 2026, my sense is that the base effects will turn favorable. And for FY27, nominal GDP growth could be closer to 10%, whereas in FY26, it was more like 7.5%. So some improvement on the margin there. But a broader point there is, my sense is that globally speaking, when we look at the region, our sense is that because Indian equities haven't done that well over the last year, some of the valuation gap vis-a-vis, the region has actually corrected at this point of time, and things are beginning to look attractive. In fact, we are overweight on equities at this point of time. We've been so for the last 1.5, 2 months. And we can see, I meet a lot of sort of clients, investors around the world. I can see the interest in India has crept back in.
Oh, okay, that's good. So just a final word, do you think the currency stabilizes below the 89 mark, or do you think 89 gets overshot? Just any view that your team will have on the rupee?
Yeah, so look, we've had a trade deficit number which has been extremely large. And my sense is while it could soften going ahead, it's not going to fall dramatically. I think gold imports will remain elevated for a while. My sense is exports will remain challenged for a while. In fact, for FY26, we think current account deficit will be 1.4% of GDP, which is almost $60 billion. Remember, last year it was $25 billion. So the pressure on the currency, I think, could remain at this point of time, especially if we don't see a deal between the US and India very soon. If we see a deal, it could be a game changer. Sentiments can change very quickly. Markets might realize that a lot of the real adjustment has happened, and now maybe it's time for the currency to perform. So it's a very binary view of the world. Okay. No deal, my sense is we can go towards 90. And if we have a deal, we could spring back to about the 87 range. So it's a wide range. A lot of it depends on the India-US deal, which is not just good for taking away a growth drag from the economy and bringing back equity flows, but over time, it could actually increase FDI inflows into the economy as people start seeing India as a good manufacturer.
Fair point. Well, a lot hinges on this very binary event. Thank you very much, Pranjul Bhandari, for joining us with a 360-degree perspective of the Indian economy. That's it.
Lovely to be here.
Thank you. That's it on this edition of It's the Economy. It's time for a break, and Chartbusters will come up thereafter.